everybody, and welcome back to another series of Decoding Pro Investors. So, in this video, we will be talking about one of the most adored fund managers of all times, which is none other than Peter Lynch. So, Peter Lynch, in his book One Upon Wall Street, has given us lots of learnings, lots of information, and lots of knowledge on how he uses some methodologies to pick stocks, what are his filters, and what are the categories according to him. So, Warren Buffett has three categories: great, good, and gruesome businesses. Similarly, Peter Lynch has six categories, and I will discuss that in detail in just a moment. So, without wasting any more time, let's get into the screen and I will explain in detail what Peter Lynch wants to explain in his book One Upon Wall Street. Let's get to it. Get to the first part. So, Peter Lynch primarily prioritizes non retail participation, non institutional participation, and high promoter holding. First and foremost filter, he does not want people like you and me to discover his picks before him, right? So, he wants minimal retail participation and not institutional participation, definitely because they're capable of rigging the prices to a very great extent, right? So, first, let's discuss the qualitative factors and then we'll go with the quantitative factors. First of all, does the company have a boring name? I am sure that all of you might have been, what is this filter? Right? So, the basic criteria is that people like you and me get away from a company just because it has a boring name, right? So, if it has a boring name or does something very boring as a business, you would definitely would not want to invest in that because you are all chased by the hype and all those trends in the market, right? So that is what he looks in. First of all, a boring name and then a boring business. Then, as I said, less institutional and analyst coverage because the more and more analysts cover it, the more and more people get to know, and there'll be more and more retail participation. Like you saw in the defense and railway rallies in 2023-24, it was an excessive boom and then bust. All of it came down crashing 50, 40, 60%, right? So that is what he wants to avoid. He wants minimal institution coverage, minimal analyst tracking, and he wants it all for himself. Its operations are maybe unethical or disagreeable. There are a lot of ethical people among us who will refrain from companies just because they do something unethical. Say ITC companies or VST industries, they produce tobacco. Would you be willing to invest in a tobacco company if you're a person of ethics and do not consume tobacco yourself? Definitely not, right? So that automatically leads to lower retail participation. And who will avoid a stock with least retail participation, right? Then a spin off from the parent. This was something that caught my eye really high because a spin off is basically one big entity getting demerged into two, and the shareholders of the big entity also receive the shares of the smaller entity. Like what we saw in ITC Hotels and ITC, we as shareholders of ITC also got shares of ITC Hotels. And what we were willing to do, likely to discard them right on the first day because those were that was a pocket money for us. Like without any investment, if they give free shares, who would say no to it? So when you do so, the first thing that comes to your mind is to get rid of the stock and cash in the proceeds, right? So that is where Peter Lynch thinks differently. So what if that company is indeed a good company and all retailers are discarding it just because it is given to them for free? Just two sides of the same coin, right? Then rumors of it being involved in a poor industry. Let's take an example, Antony Waste Limited, right? Do you see the company to be attractive? No. The company's name itself has waste, so definitely it will be a waste company, right? Then poor industry, waste management, really overlooked industry, a really undervalued industry. Not many people identify the potential of waste management because the kind of waste we generate in daily lives, it is excessively high, and for management industries to thrive is on those wastes. And when we generate higher waste, it means directly higher profits for them. So this is just an example, not like a stock recommendation on anything, but you see how it correlates with each other. Then something depressing about it exists. This basically means pessimism in the market about a particular company. So recently we all saw Gensol, right? Really bad, accused of money laundering, not money laundering, accused of fund misappropriation, or all sorts of shady things, right? But let's just think about it from another side. We had the Polycab or 361 where the income taxes people raided their offices, right? It is definitely a negative among the market participants, right? And all of the people, if not many, uh, would have definitely resorted to discarding the company. They would have resorted to low trimming their stakes or even exiting their stakes on the whole. But this is where Peter Lynch thinks on a different scale. So when everybody is selling, then who will be buying? Will either be the promoters or it will be fund managers like Peter Lynch who's waiting for opportunities to pounce on. Then belongs to a no growth industry. This I'm particularly surprised because if there's no TAM, the total addressable market, then there will be no possibilities of growth. The top down approach of modeling is completely gone because there's no sectoral growth. Then how will the company grow? Even if it gains market share by 100 basis points each year, then even then there's no particular scope for growth. So I do not know how to decipher this and if it has to be implemented. Yeah, the niche industry, that is something I particularly love. A specific niche. Let's take the company, uh, this thing, the BLS International, which we took in the last video, right? What does it do? It offers visa and consular services. To whom? To retailers like you and me. Can anybody enter it? No. Barriers to entry is high. Does it have substitute? Yes, only one, and it operates in a duopoly. So obviously, it is operating in a niche. Or let's take Zen Technologies, right? It is operating in anti-drone systems and simulation systems. So that is a niche it has created, and not many people have access to it right now. So it is kind of operating in a monopoly or duopoly environment, and which gives access to a huge TAM, a huge market share, potential, and a huge growth potential, right? Inevitability of the product. That is a key from Peter Lynch's book. So if the product is inevitable, then obviously you will keep buying it. You will not stop buying soaps or food for your family because that is how you thrive. So inevitability of product is one. Then user of tech, dynamicity of the business. If they are embracing technology, like the AI revolution, if they're embracing technology, if they are using technology to boost their income, capitalize on operating leverage, that is point. And then insider buying, the promoters are buying. When do promoters usually buy? When they feel that their shares are undervalued. And the promoters, whether we agree or not, have the biggest access to information, and the costs of asymmetrical information are quite high. If you're wondering what costs of asymmetrical information are, it is the costs, it is a qualitative cost that the management has more information that we as retailers or shareholders do, right? So with the qualitative aspects done, let's get into the quantitative aspects. So we want PEG, which is the price to earnings to growth ratio. So we all know PE ratio, which is the price by EPS, and if that whole ratio is divided by the growth rate, and if the whole ratio is less than 1, then it is a good industry, good growth industry. So let's take a company with a PE of 80, okay, and the management guides for 80% growth. So it means a PEG is 1, right? And similarly, a company with a 50 PE, a company guiding for 5% growth rate is a 10 times PEG. You ideally want to go with this. The peg, lower the PEG, the better it is, right? Then cash equivalent per share, this I will show on the screener to arrive at the floor price. And then the holding company. Now, who holds stake in that company? Let's say the subsidiary company's parent company. If their holdings in this company, let's say there's a small subsidiary of 10 crores, okay, just hypothetical purposes, and the holding company holds 90%. So they basically hold 9%, 9 crores worth of shares. And if the holding company is itself valued at 5 crores, then there is a huge mispricing that is occurring, right? So the 4 crores is still not unleashed by the market. So that is the holding company play, and that is what is asset play that we will describe in the categories. Okay. So next is the promoter buying. Promoter buying, as we said here, and high promoter holding, less institutional ownership. Strength of balance sheet basically means a lower debt equity ratio for capital, um, not capital intensive companies. For service companies or those which do not require so much capital. And then a P multiple below peer and historical average, and a sales and profit growth above 20%. That all of those are basic criteria. Then we have 6 categories that Peter Lynch divides companies into: stalwarts, slow growers, fast growers, cyclicals, asset plays, and turnarounds. So stalwarts are all those big dividend paying companies like Reliance or ITC, which have not much scope for growth but pay hefty dividends, right? And then slow growers absolutely avoid low market share, total addressable market. They are not meant for growth. Fast growers, this is where the multi-bagger lies, as per him. This is where the 20 baggers and 30 baggers are found, right? Then cyclicals, we have the steel sector, which is cyclical to the business cycle and all those. You get my point. And then asset plays. So this is the holding company example that I mentioned. If the holding company's stake in the company is valued more than what the company on the whole is valued, then it is an asset play. If the company's assets are greater than its market cap, so basically the price to book to be less than 1, which is not very common in the Indian market scenario, I am telling you. And then we have turnarounds, which have reversed their business. So let's say NACL Industries, which have been acquired by the Murugappa Group, excellent turnaround. And Suzlon, the best example. Before 2022, it was an absolute garbage company making losses. But look at it now. Look at the kind of returns, exponential returns that it has generated. So that is an example of turnarounds. So without wasting any more time, let's get it into screener, and we will see how to filter these companies. So you basically go into screens, create new screen. What did we want? We wanted the peg to be less than 1, right? And we want ROE returns to be quite high. That is also an indicator of balance sheet strength. ROE greater than 15% and ROCE greater than 15, and we want the price equity to be PE ratio to be less than historical PE of 3 years. Let's take it for now. Then no, my bad. Then debt equity to be less than 1. Okay, and oh my goodness, then what do we have? Promoter buying, less institutional ownership. So first of all, sales growth is greater than 20, and profit growth is greater than 20, and then we have less institutional interest. FII holding plus DII holding to be less than 20, and promoter insider buying, we will filter it later, right? So that is all we have, and let's run the query. No 20, and just run the query. Okay. Oh yeah, my bad. Yeah, so this is the universe of companies that we are looking at. Now from this you can filter out technology. You can filter out companies which have a good TAM, good market share growth, and probably a higher prospects going forward. So let's just take an example for now. Shilsha Technologies, I told you that I will help you with the cash equivalent per share. So here we are. We go to the balance sheet. What do we see as the cash reserves? Cash equivalents are 37 crores, right? So if what the total cash per share, if the company is holding what 37 crores worth of cash and cash equivalents, then its value cannot be less than 37 crores. Okay, so this is your floor price that you pay for a company, not 37 rupees, 37 crores of market cap, and its market cap is 5527. So price to cash equivalence is quite high, right? And peg ratio is 0.28, ROE ROC is high, then the sales growth is definitely high. See, so this is the kind of thing that I wanted to explain. So with this being said, that is how Peter Lynch filters his stock companies. So with this, you deep dive into companies where you identify a good sector growth potential, the TAM growth. The TAM growth is something which you have to keep in mind, total addressable market. So without that, all of your bottom up analysis goes to trash. Okay, if there's no TAM, there's no growth, remember. So all of it is done, and I'll see you in the next video. Or until then, I sign off. Thank you.